Making sense of your payslip. Hi, this is Patrick here from the Facebook group and social media platform for PAYE workers to ask and get answers to their questions. The group is called Payroll Matters in Ireland and new members are always welcome. Today I want to talk to you about reading and understanding your payslip in simple terms. The most difficult thing about making a video like this one is that there are so many different layouts depending on the payroll software and the company you work for. You can see here the many varieties there are, and believe me, there are hundreds more. As you can see, some are more detailed than others. However, there is a general pattern that is followed by most. Across the top, your master file and personal details appear. Details like name, PRSI number, job details, etc. In the middle are details of the current pay period, pay and deductions. Across the bottom are details relating to cumulative tax and details from your tax credit certificate. Firstly, what is a payslip? Your payslip is a written statement from your employer and at the very least must legally show your gross pay, and that means your total earnings before tax and any deductions from your pay like income tax, universal social charge, pay-related social insurance and other deductions. Income tax, USC and PRSI are statutory deductions and are known as PAYE or pay as you earn in Ireland. Your employer must give you a payslip every time they pay you, either when you get paid or shortly after. So you must be given a payslip with every payment of wages. Your employer can choose whether they give you a printed or electronic online payslip. Your right to a payslip is contained in Section 4 of the Payment of Wages Act 1991. Your payslip can be used as proof of your earnings, tax paid and any pension contributions. Pay as you earn, PAYE. As we already said, PAYE are income taxes deducted by your employer using revenue's pay as you earn system. So, pay as you earn is the system name for deducting income tax, PRSI and USC from your wages or salary. Employees normally pay tax through PAYE, and every time their salary is paid, their employer deducts income tax, pay-related social insurance and universal social charge, and pays the amount deducted to revenue. PRSI is technically not a tax because social insurance contributions are paid to the social insurance fund to provide the contributory state pension and other entitlements. These deductions are called statutory deductions and are required by law. I'm not going to go into all the mathematical calculations for determining your tax, PRSI and USC, as we have easy to use calculators for doing that, and I will show you during the video where to locate them. One of them is here. It is called year-to-date cumulative income tax and universal social charge, USC calculator. Income tax in Ireland in 2024 makes up approximately 40% of the government's tax revenue and is paid by approximately 40% of the adult population. The income tax system in Ireland is complex, dynamic, and is made up of several different rates, credits, bans, and reliefs. What I am going to tell you about is the layout of a payslip and the definition of payslip items. The sections of a payslip, as I mentioned earlier, generally payslips are designed in sections. The one standard thing about payslip design is that there is no standard. I'm going to go through some of the normal terms on your payslip and what they mean. All of these may not appear on your payslip. The personal and job details section. This information is usually shown across the top rows of a payslip showing your personal information such as your name and works number. Your PPS number. A personal public services PPS number is a unique identifier used by statutory bodies for tax purposes. And when people need to access social welfare benefits, public services and information in Ireland, other previous names were pay-related social insurance number, PRSI number, social insurance number, revenue and social insurance number, RSI number, your employer's name and registration number. The company name may appear, but very rarely does the employer registration number. The time when this would be useful to know is when you start your first employment and you need to register for the first employment with revenue. We have a step-by-step video here on our channel called How to Register Your First Employment. Pay frequency. Pay frequency defines how often you as a PAYE employee is paid. The most common are weekly, fortnightly, 4-weekly and monthly. A pay date. Pay date in the context of PAYE modernisation is defined as the date on which the funds are made available. These dates can be different depending on how the employer makes payment to the employee. If you are paid by cash, it is the date the cash is given to you as the employee. If you are paid by cheque, it will be the date on the cheque. If you are paid by bank transfer, it is the date which the funds are scheduled to be made available in your bank account. Where a payday falls on a non-bank working day and employee payments are due, revenue regards that day as payday. This occurs provided the funds are made available to the employee on the previous bank working day. Pay period. The pay period in question on your payslip, for example, month 6 or June. This may be referred to as tax period on some payslips. They should be 1 to 12 for monthly, 1 to 27 for fortnightly, 1 to 53 for weekly, and 1 to 14 on 4-weekly. The 53, 27 and 14 are when there is a week 53 in the year, etc. Week 53. This applies when there are 53 weekly paydays in the year and occur infrequently. This occurs when a payday falls on the 31st of December. In the case of a leap year, on the 30th or 31st of December, like this year, 2024. Additional paydays can apply to employees who are paid on a weekly, fortnightly or 4-weekly basis. It does not affect monthly paid employees. Regulation provides that the employer should use the latest revenue payroll notification, the RPN, to deduct income tax on a week 1 basis for period 53. Here are the tax periods for 2024. For weekly paid staff, the tax period and the pay period should be the same. For fortnightly paid staff, tax week number 10 would equate to pay period 5. Just remember that it is the pay period we use for our calculators. Statutory deduction details section. These details are normally shown on the bottom rows of a payslip and give the payroll details to enable the employee to calculate the statutory deductions. A summary of your total pay for the year so far, cumulative pay, or on some payslips, year to date, or YTD, may also be shown in this section. Tax cut-off point. Tax rate band or standard rate cut-off point, or may be shown as SRCOP on some payslips. The amount earned each time a person is paid before they must pay the higher rate of tax. Every time a person is paid, they pay tax at the standard rate of tax, which is referred to as their standard rate cut-off point, or SRCOP. A tax rate band is the amount of income which will be taxed at a particular percentage rate. The current 2024 tax rates are 20% and 40%. A portion of income is taxed at 20% and the remainder will be taxed at 40%. So, in brief, your standard rate cut-off point is the amount you can earn before you start paying the higher rate of tax. Learn more about how your income tax is calculated and explained in detail using simple terms for all PAYE workers to understand on our video called PAYE System for Workers. Tax credits. Tax credits reduce the amount of tax you pay. Everyone is entitled to tax credits based on their personal circumstances. For example, if they are married or in a civil partnership or are a PAYE employee, etc. Tax credits are allocated each year and tax is calculated as a percentage of a person's income. Tax credits are deducted from this to give the amount of tax a person will pay. Any unused credits are forwarded to the next pay period for PAYE workers with tax credit certs issued on a cumulative basis. Tax credits carried forward will reduce the tax by the amount of the credit in the next pay period. PRSI class. PRSI contributions are divided into different categories, known as PRSI classes. There are 11 different PRSI classes. This determines the rate of PRSI, or rate of contribution, employees are liable to pay. The class and rate of contribution paid is determined by the nature of the employment and weekly earnings. For example, a person employed in a supermarket earning less than €38 per week will be insured under Class J. If that person earned over €38, they would probably be insured under Class A. Most private sector workers are liable to pay Class A PRSI. There are a variety of PRSI classes: A, B, C, D, E, H, J, K, M, S, and P, and subclasses such as A1, J0, CX, etc. Each employee has a PRSI contribution class. The Department of Social Protection provides details of each PRSI class and the PRSI contribution rates. The class of PRSI pay determines the social welfare benefits for which a person may qualify. The range of benefits includes the likes of the state pension contributory, job seekers benefit, and illness benefit. An entitlement to a benefit is dependent on a person meeting specific criteria. PRSI subclass. Each PRSI class is in turn divided into different subclasses. So, for instance, you could have A0, AX, AL, or A1. These subclasses do not affect entitlements under the social insurance system. They only relate to the amount of PRSI which employees or their employers must pay. You do not have to be concerned about these subclasses, as our calculators determine this for you. Number of insurable weeks. Insurable weeks are the number of weeks that your employment is liable for PRSI, social insurance contributions, for the pay period in question. Taxable pay. Pay for income tax or taxable pay is gross pay less any contributions that are deducted from gross pay before an employer calculates employees' tax. On most payslips, this will be shown as a this period value and a year-to-date value. Week 1, month 1 basis. A PAYE worker may receive a tax credit certificate on a week 1 basis, also known as the non-cumulative basis. This means that their employer will deduct income tax from their pay on a week-to-week basis. Yearly tax credits and rate bands are not backdated to the 1st of January and do not accumulate for each pay period. Employers cannot make any refunds of income tax that may be due until a cumulative tax credit certificate is issued. Current period deductions section. The difference between gross pay and net pay is withheld deductions. Payroll deductions are amounts withheld from an employee's pay each pay period. These are both statutory and voluntary deductions. Pay-related social insurance, PRSI Ireland. Pay-related social insurance means the social insurance contributions deducted from your wages. The term insurable employment is used to describe employment that is liable for PRSI contributions. PRSI, pay-related social insurance contributions, which go towards social welfare benefits and pensions and enable people to qualify for social welfare payments such as old age pension, illness benefit and maternity benefit. Revenue collects PRSI contributions in most cases through the PAYE system. Most people working in Ireland must pay this, with few exceptions. PRSI is a payment made by employers and employees. The value of this payment is based on the amount of employees paid. PRSI is the main source of funding for social welfare payments. Pay-related social insurance contributions go to the Social Insurance Fund, which helps pay for social welfare benefits and pensions. Most employers and employees between the ages of 16 and 66 and pensionable age, currently 66 years, pay social insurance PRSI contributions into the National Social Insurance Fund. The Social Insurance Fund consists of money collected from people in employment. This money is then used to fund social insurance benefits. The investment account is a saving. Employees PRSI. Employees PRSI, or as you might see on your payslip, PRSI EE, is your pay-related social insurance, also called your social insurance contributions. EE means that it is paid by the employee. Employers record and pay PRSI contributions for all employees aged 16 and over. The employer share is the amount of PRSI employers pay based on employees' pay. It is generally not shown on a payslip, and if it does, it may show as PRSI ER on your payslip. Your pay-related social insurance, also called social insurance contributions. ER means it is paid for you by your employer. PRSI total, if it appears on your payslip, is the total combined amount of pay-related social insurance paid by you and your employer on your behalf. An employee's share is the amount of PRSI an employee pays on their own pay. The total amount paid for an employee in one pay period is called a PRSI contribution. Universal Social Charge. USC, or the Universal Social Charge, is a tax that has replaced the income tax levy and health levy. USC is a tax payable on total income, but there are some types of income that are exempt. Universal Social Charge is a tax you pay if your gross income is more than €13,000 per year. All payments from the Department of Social Protection, the DSP, are excluded from gross pay for USC purposes. USC is at the standard rate or the reduced rate, dependent on one's circumstances. If a person's circumstances change, for example being granted a medical card, revenue must be contacted, as there is a reduced rate of USC for medical card holders, and only revenue can apply it to people's tax certificates. Voluntary deductions. Voluntary deductions include health, life insurance, unions, retirement plans, etc. Voluntary deductions may be revenue approved and not included in taxable pay, or taxable deductions which are not taken off gross prior to tax calculations. This period payment section. The difference between basic pay and gross pay is additional pay like overtime, extra duty, premium pay and bonuses. Basic pay, this is your salary, not including extra payment types, for example, overtime. Gross pay, this may also be called your total pay before any money is deducted, such as tax, USC, PRSI or pension contributions. So total pay is the total amount a person is paid before any deductions are made, and includes wages, basic salary, notional pay, bonuses, premium payments, allowances, and any shift premium, overtime, commission or bonuses, etc. Overtime. Overtime is work done outside normal working hours. Employers have no statutory obligation to pay employees more per hour for work completed in overtime. However, many employers pay employees higher rates of pay for overtime. A contract of employment should state whether one is required to work overtime and should set out the rates of pay where one is to be paid for it. Premium pay. If an employee works at night or on Sundays or other unsocial hours, they may be entitled to extra pay, as may be agreed between the employee and the employer. Under the Organisation of Working Time Act 1997, night work means work done between midnight and 7 a.m. Public holiday pay. When a person meets the criteria for public holiday entitlement, they may be paid for the day in accordance with their agreed rates, and this may be shown as P/Hol on their payslips. Benefit in kind, a term used by revenue to refer to a taxable non-cash payment to an employee, for example the use of a car, preferential loans or subsidised accommodation. A benefit in kind is any non-cash benefit of monetary value that employers provide for employees. These benefits can also be referred to as notional pay, fringe benefits, taxable benefits or perks. The benefits have monetary value, so they must be treated as taxable income. Net pay. Net pay is the take-home pay an employee receives after payroll deductions. One can calculate net pay by subtracting deductions from the gross pay. Net income is the money take home after all taxes and voluntary contributions have been deducted from your gross salary. The total amount to pay after tax, PRSI and Universal Social Charge and other deductions are made from gross pay is net take-home pay. Your net pay as used in our calculators is your total take-home pay after all taxes and other statutory deductions are made, as there is no facility in the calculators to account for voluntary deductions. Questions. If you have any questions about your payslip not answered here, you should contact the payroll section of your company. Deductions from your pay. Your employer is allowed to deduct money from your wages if the deduction is required by law, such as tax, universal social charge, and social insurance, PRSI. Your contract may say, for example, your employer can deduct your occupational pension contributions. Your employer can make a deduction if they are taking back an overpayment of wages or expenses. In cases where you have given your written consent, for example, for a trade union subscription, a deduction is required by a court order, for example, an attachment of earnings order in a family law case. You have not worked due to strike or industrial action. Deductions for uniforms or employee error. Some employers deduct pay if they supply you with a service as part of the job, for example, a uniform. They may also deduct pay if they suffer a loss because of something that is your fault, such as the breakage or till shortage. In these cases, a deduction is only allowed if your contract says they can. If it is fair and reasonable, you get written notice, which must be at least a week's notice if it is due to your mistake. The deduction is no more than the loss or cost of the service. The deduction takes place within 6 months of the loss or cost. Mistakes on your payslip. If you think your pay is wrong, speak to your employer first to try to sort out the problem. Informally, ask them to explain anything you don't understand on your payslip or why you have not been paid. You can also ask a question on the Facebook group Payroll Matters in Ireland. Your employer is allowed to make a mistake or forget to include something on your payslip once they can show it was unintentional or because of an administrative error. If you have been overpaid by mistake, your employer will usually take back the extra money in your next payment. Incorrect or no payslip. If your employer does not give you a payslip, or they give you a payslip that is intentionally made up or false, they have committed an offence and can get a fine. How to make a complaint. If you have a complaint about your payslip that you cannot sort out with your employer, you can make a complaint to the Workplace Relations Commission, the WRC, using their online complaint forum. You must make your complaint within 6 months of the date of the deduction. The time limit can be extended for a further 6 months, but only if there is a reasonable cause for the delay. Don't forget to hit that subscribe button to keep up to date with Payroll Matters in Ireland. Thank you for watching, and I will see you next time.